Kitchener. Oh, we're recording. I can start all over. Hello, everybody. Thank you for joining us. Anyway, yeah, Kitchener. For some reason, we're getting a lot of clients, a lot of real estate agent clients in Kitchener. So I thought I would show up as people in the back go, "You're real. There is a Gerry. Yes, there is a Gerry." Anyway, I am Gerry Hogenhout, and tonight we are going to talk about taxes and investments, my two favorite topics in the world. Here we go. How do I move this thing? Duran, you got the little thing here.
Do you want this?
No, give me that. That's okay. So, quick introduction to me. I'm just going to do it real quickly. I'm a chartered professional accountant and certified financial planner, real estate investor. Um, Work-wise, I worked at the Lake Touche for 10 years, worked in their tax department, in their small business department. Absolutely great foundation for what I've been doing for the rest of my life. I had a little entrepreneurial seed planted in me somewhere in the way. So the corporate life, thank you for 10 years. See you later. Bye. Set up my own practice, tax practice at first. Little did I know at that time, it was really it led me down the road of investments, real estate investments. I'll talk a little more about that. Um, yeah, okay, click so three things happened while I was at Lloyd Touche, and after I set up my own practice that even to this day really influences me a lot in what I'm doing today and the road I've traveled. One, at Deloitte Touche, we did IPOs, initial public offerings. And way back then, it was just a job. It didn't really mean anything to me. We would take private companies and take them public. It sounds kind of neat, and it was neat, but it was really hit me because a typical example would be we'd have a private company. Step one is to value that company. Then we do all the underwriting and we take it public. But in simple terms, we look at a private company, we value it, we'd say, okay, you're worth $2 million. We would issue 2 million shares. And the owner of the company we give them 1 million shares plus one. So they're still driving the bus. And we go to market with 1 million shares minus one. And so we knew that if the company's worth $2 million and we issue 2 million shares, each of those shares are worth $1. And then it hits the market, $2 and goes up to 2.50 and $3. And I remember when we're doing all this stuff, I was just in awe that these prices on the market. I was just a young guy back then, like, okay, this thing's trading at $5. I know it's worth $1. So the whole idea of protecting capital was ingrained in me because we were not doing that. The public market was not doing that. And I still say to this day that every stock out there is way overvalued to its liquidated value. So when I eventually got into the investment business, which I'll talk about, two things we do. We have to protect capital. We have to make a rate of return. So when I look over at the stock market, I'm like, I'm not really too convinced that we're protecting anybody's capital over there. So I've always been skeptical in the stock market. And you can make money over there. Okay, I'm not saying you can't make money in there. I'm not saying don't go in the stock market. I am saying it's not a really great place to protect your capital, as far as I'm concerned. So that's one thing that always stuck in my mind. When we take these private companies and they go public, and when you do go public, your value is really based. When you're a public company, you have to do audited statements every quarter. And if you had a good quarter, your stock price. If you have a bad quarter, your stock price goes down. There's reasons why private companies go public. One, to raise capital. Two, like most owners of companies that do go public, they want their share price to go through the roof and they become millionaires, billionaires. Mark Cuban, when his company went public, his whole staff became billionaires like in 1 day or 2 days. It just the market, the stock hit the market and went boom. So they're all billionaires. So that's people's casino rama. So that's why they do that. But it's always stuck in my head that all these stocks, if you take any company, share price times shares outstanding equals capitalized value, That's way more than what the real company is worth. Nortel is a great example, right? And you're laughing. I mean, trading at what, 123 or something, liquidates at 66 cents, and that's a blue chip stock. Whew. Anyway, so that's stuck in my head. Didn't really mean too much to me way back at Deloitte because I was just doing my job. But once I got into the investment world, I'm like, well, stock market things. Also, what happened is I purchased my first rental property way back then, and that was scary. Holy moly! It was $65,000. It was a ton of money. Oh my God, was I scared? I had no money. I had to sell my car. But anyway, I did it. And all of a sudden, I'm like, oh, this is pretty cool. They just gave me 90% of the money and, put a tenant there. And I'm actually making a little bit of monthly cash flow. And my mortgage is going down and my house went up in value. So those things really, this is pretty good, this real estate thing over here. And then the other thing that happened when I left Deloitte's, and even at Deloitte, certainly when I started my own tax practice, I would have people come to me and go, Gerry, somebody's trying to sell me something. What do you think? And could have easily said, well, I don't know, I'm a tax guy, I'm not an investment guy, but I was interested. So I really dug into it and started learning a lot about investments. And that really planted a seed in me too. So that started me on my way. So when I left Deloitte's, I set up my tax practice and I got so interested in investments that I thought it would be a good complement to my tax practice. So I expanded my tax business to add investments. Oh, click, you did click already. You're way ahead of me. So anyway, so the one thing that I really learned was how much integration there is between your tax world and your investment world. And I can't believe more people don't do this. You go to your accountants to get your tax done, and you go to your investment people to get your investments done. And there is so much integration that it just makes more sense to have everything done under one roof. To have the tax people looking at your investments, to have your investment people looking at your taxes. There's so much. And I just find CPAs in general, accountants, the people doing your taxes don't talk to your people doing your investments in a nutshell. And I think that's a big problem because I've seen so many clients, they're happy with their accountants, they're happy with their investment people. And when I look at their things, I'm like, well, why aren't you doing this? Why aren't you doing that? That's wrong. That's not right. So there's so much that you lose when you don't integrate your taxes and your investments. So I always thought it was a great combination. And that's how I built my business. And so basically, for investments, we need what's called IPs, investment products. And we're going to talk a lot about that. And when people ask me, why are you bringing these things out here? Because these are investment products. This is really the investment marketplace. And I'm going to keep going back and forth because this is more the stock market and this is the real estate. So we'll keep going back to these things. And I know when I first started in the investment world, I just had my one little property, and I had, I didn't really know a lot about the investment market took place. So I had to get an investment license. So the first one I got was MFDA, Mutual Fund Dealers of Ontario. MFD, whoops. MFDA. So these are your 5 licenses. That says OSC, which is Ontario Securities Commission, FSRA, Financial Service Regulatory Authority. And these are the licenses that people can hold. So there's 5 investment licenses that you can hold: an MFDA license, an IROC license, an exempt market license, a mortgage license, and an insurance license. So as I started getting into the investment side, I started with my MFDA license, which is mutual funds, which means I had to be a mutual fund salesperson. And I already had this background on these stocks, and as we probably all know, mutual funds is a group of stocks. So I'm skeptical. Fortunately, the first couple of years I did that, the market was good. So everybody's, oh, Gerry, that's great. I mean, 20%, that's awesome. Okay, all right. I don't know. I'm still skeptical on these stocks, but the market was doing okay. And I remember back then, I'm like, okay, so these mutual fund things are doing okay, but why aren't we doing any real estate? Right. And the people who I worked for at the time were licensing me. They're like, no, real estate's risky. Stay away from that stuff. Keep everybody in mutual funds, right? And at first it's like, oh, okay, I didn't know any better. And then you start to figure out the way the whole industry works. And it's just a sales game. It's so really boils down to, I was really on my second real estate property, and then the market and the stock market goes down a little bit. And I'm like, oh, that's not good. All these things that I'm worried about, the values, the market went down. And the cool thing about having like an MFDA license and then an IROC license is you're connected and talk to really smart people with CFAs and MBAs, and they know all the reasons why the market's doing what it's doing. And I'm like, oh, okay, well, you must know what's going on. Well, here I am, I don't know how many 40 years later, going, I've never met anybody yet that can accurately predict where the stock market is going. So all that stuff is BS. It's just being said to keep you invested in here, MFDA. This is where the banks love it. The banks just put people in MFDA and IROC. So MFDA is mutual funds, IROC, you get into stocks and bonds. So these are investment products. So the investment products you get from the MFDA is mutual funds. The investment products you get from IROC license are stocks and bonds. The exempt market, that's private equity. This is public markets that I talked about. Okay, these are traded on the Toronto Stock Exchange, the Dow Jones. This is private markets. We're going to talk about that. Mortgages, the investment products we get there are basically mortgage lending. Insurance, investment products we get there are seg funds. Where's the real estate? There isn't any. It's all over here. Okay, so there's the 5 licenses that you have to work in the investment industry, and nobody's talking about this, which is a huge problem. It was a big problem to me because I then bought my third real estate property, and I'm like, this is pretty good. And now I'm becoming not a seasoned investment person, but I start to know a little bit. I'm like, these companies that license you just making me go out there and sell these mutual funds and stocks, and nobody's talking about this stuff, right? So that was kind of a problem, and then I realized how the system works. It's kind of sad to say because when you are when you hold an investment license, you can't, your fiduciary responsibility is to the company that licenses you, not to the client. And that's a problem.
Quick question.
Yes, sir.
When you say this, can
Yes.
you give us a little idea because the people are online are saying they're unable to
Oh,
see
well,
it.
yeah, they can't see it. Well, I don't know if they can see these things. So on this side, we have what we call the public market, stocks, mutual funds, private equity. On this side, we have different types of real estate related investment opportunities, investment products, land development, fix and flips, direct private lending, multi-unit, RSP mortgages, real estate assignments, real estate pre-construction, buy and holds, LPs, joint ventures, wholesaling, apartments, rental properties, all kinds of real estate investments that none of these licensed people talk about. Big problem, big problem. Okay, so next one. So it was such a problem that I'm like, well, how do I do this? I want to be an investment person. How do I talk to my clients about all this? Well, I'm holding these licenses, and the companies that license me tell me, don't talk about that, just sell the stuff that we tell you to sell. So it was just a big problem. So time to create my own company. There we go. Okay. So I finally said, well, the investment marketplace does not function properly. I still say that today. It's too much sales driven. I really wanted to create a company where I could do all this real estate, still have access to all this stuff. And the only way I could do it was to give up all my investment licenses. So over time, I had an MFDA license, an IROC license, I had an exempt market license, I had a mortgage license, I had an insurance license, which made me, and I'm not saying this to be boastful, just to lend credibility to what I'm saying. I ended up being the only person in Canada with a CPA that had all these different licenses. So, and again, I'm not saying that to be boastful, just lending credibility to what I'm saying. I don't want an investment license because if I don't have an investment license, I can do all this real estate stuff. So the company I wanted to create was basically to access all of these investment products for people and not be tied to a company that says you have to sell this, you have to talk about this, you have to do this. So that's the way I've set up my company, and I've solved the, click on the next one, Duran, if you can. So my goal was to solve the problems that I saw existed in the investment industry, which was 99% of the advice that people get is from someone trying to sell you something. And that's not right to me. Okay, but that's the way the industry works. 99% of you get investment advice from someone trying to sell you something. Don't blame the advisors. It's not their fault. It's the way the industry is structured. Okay, they structure it that way. It's run by the Ontario Securities Commissions. If you look at who's sitting on the board of directors at the Ontario Securities Commission, it's that bank, that bank, that bank, that bank, that bank. They want your money right there, and they don't want you to do anything else with it. They make a ton of money here. Okay, so the system is really skewed. So again, don't blame the advisors. Again, in my opinion, I don't like selling. I don't think I sell. We don't sell. What we try to do is educate the client, give them the right information, give them access to whatever they want, real estate, non-real estate, and get the client involved in figuring out what they want to be invested in. So I proudly say, it's in all of our clients, certainly most of them are invested in what they want to be invested in, not something sold to them. Okay. And most people want access. Yeah, the real estate, most investors want access to all this real estate stuff over here. Okay, they want to be involved in all this stuff. So anyway, and plus then I also wanted to create my company that there was an integration with taxes and investment management. Because there's so much integration. We'll get into a little bit of that. Next one. Okay, so how do I do it? Well, no licenses. I don't have any license restrictions. So I can focus on this stuff, which we do. Basically, we've been involved in pretty well everything that you see here or have heard here. I still have access. I can still get access to this marketplace through licensed advisors. I can talk to people about everything that's going on here. I can't process an order. I can talk to you about all this stuff. Hey, you want some MFDA, you want some IROC, we have to bring in a licensed person to process the order. So it's the only thing I can't do without a license, which is fine. I don't want a license, because then I can do things the way I want to do it. It also allows me to do more, again, capital protection. So when we manage money, two big things. We have to protect capital, we have to make a rate of return. And I think protecting capital is much more important. Okay, as real estate, we all know there's good real estate and bad real estate. Good real estate is a real good way to properly protect your capital. And most of the real estate, even with very, very low risk, is making 10% consistently every year, not the ups and downs. So I think it's a great way to integrate those two things. I just find a lot of the people with the investment licenses aren't quite as concerned about the protection of capital that they should be. So internally, where do we get all these real estate investment products? We create them internally. We do a lot of it internally. We create our own real estate projects. We buy apartment buildings. We bring in our clients if they want to be. We just present it to them. Hey, client, you want to get involved in this apartment building? All this stuff, direct lending, fix and flips. We kind of slow down the fix and flips. We did a number of fix and flips in Etobicoke. We lucked out, we did good, but the way the market is now, our old model was more buy something for $1 million, literally knock it to the ground, put 5, 6, 700,000 into it, and sell it for 2 point something, hopefully. And that model seemed to work. Now you got to pay 1.5 for a knockdown. Now you're playing in that $2.5 million market, which is pretty scary. So when we talk about protecting capital, that's not the greatest thing, I don't think, at this point, because even when we do invest in real estate, we're doing one of two things. We're really speculating, or we're buying cash flow. So a fix and flip, for me, is more speculative. You know, I could say, hey, you want to get involved in a fix and flip? And let's say you do. I'd say, okay, here's the risk. I'll make sure the house gets knocked down and rebuilt, but I have no idea where the housing market is in 9 months. It's going to take us 9 months to do this, 3 months to close. So we don't know where that, that there's a risk involved. So as long as the client's willing to take the risk, no problem. So we make that well known to them. On the other side, when we're buying cash flow, which is really my favorite thing to do, we're buying apartment buildings. And apartment buildings, we'll find out later, is probably my favorite investment, just because we're protecting capital. We really base it on a lot of the things we know. We'll talk about that in a little bit here. Yeah, so again, so we focus on education. So our CIS equals EIS, Canadian Investment Services equals education, information, and then selection. So we want to give you the right information, unbiased. When we give you information, we're not trying to steer you over there or buy this. No, just the good, the bad, everything has good and bad to it. Everything. Okay. So we try to give you the good, the bad, figure out where you want to be, and we take you there. Okay. We really want our clients involved in their product selection. Most of them do. Some don't want. Some very personal and busy. Go buy me something. So that's okay. But we really like to get the client engaged. So basically, the Canadian Investment Service, what we do, we manage investment portfolios for people. We create investment products, IPs for people. We have access to investment products for people through third parties if need be. Also, I'm a public accountant. Okay, so we have a public Canadian Investment Service is a public accounting firm. We do personal tax returns, corporate tax returns, trust tax returns. So again, there's a lot of integration between these investments and the taxes. So on the topic of taxes, let's talk about some taxes. So again, I'm a public accountant, and yeah, that's pretty small. I can't even read this here. Okay, there you go. Okay, one problem, again, we really believe in saving taxes. Okay, we've been given a gift. We spent a lot of time with Deloitte. We know the Income Tax Act inside out. We should use this information to save taxes and not just file tax returns and be compliant. Or I find a lot of accountants are just doing tax returns and being compliant and not really trying to strategize to save the client's money. Okay, like for example, I always say the Income Tax Act, that's our Bible, that governs what we do. Half of it is written in black and white, very clear to us what we can and cannot do. The other half is written in gray, very, it's interpretive. Can you deduct your car for business? Sure. How much? Well, so you just say, well, you're into the gray area. Okay, can you deduct your office and home? Well, yes, of course you can. How much? Well, we're into the gray area. Okay, so when we go into the gray area, what I always say to clients is, nothing happens, nothing is illegal over there. I don't do anything illegal. Okay, and if you do, I don't want to know about it. Okay, so we go into the gray area. It's legal. We're not breaking rules. We're being interpretive to our favor, not their favor. Them being CRA. Okay, so we can go in there. For example, your car. Okay, how much you want, probably 90% of the tax returns, if not more, we do. The client's like, yes, okay, I want to deduct my car. Okay, how much do you drive business wise? Oh, all the time. I drive my car all the time for business, or 90%. And can we prove it? Do you have a mileage log? Okay, what CRA actually requires from people for their mileage log? I haven't seen anybody keep it ever in 40 years. Okay, it's just insanity what they want. What they want, you leave the house, you put down your odometer, you document where you're going, you document who you met, you document what you talked about, you put your odometer again, you go to the next place. It's insane. Nobody does it. Okay, I myself, I put my odometer reading down Monday morning, Friday afternoon, the end of the year, I go, okay, Monday morning, Friday is business, Friday afternoon to Monday morning is personal. I have something. That's the key. Have something. Okay, because if we're doing your taxes and we're filing it, you like this gray area. You go, this is awesome, Gerry. Take me to the edge of that gray area, Cliff. Let's go. Let's save us some money. We're the ones stuck dealing with CRA in the case of an audit. Okay, so you gotta have something to give them so we can help. But the gray area is, again, some people dip their toe in the gray area. Some people go to the edge of the cliff in the gray area. Some people are in the middle of the gray area. I actually encourage people to save tax, go into the gray area, be comfortable with a bit of audit risk in your life. It's legal. We're not breaking the law. We're just trying to save you taxes. And what is the audit risk? The audit risk is that they will, when we send a tax return, so if we're doing your tax return and we're ready to hit send, I hit send, my computer sends it to their computer, and their computer spits out a notice of assessment and it has a date on it. And they have 3 years from that date to question anything. So when my computer sends it to their computer, a human being hasn't even looked at your tax return. Now there are systems at CRA have all kinds of algorithms to catch stuff, so we know what they are. I know what not to put on a tax return, where to hide something on a tax return. So we try to avoid all those algorithms, but there's nothing that prevent, I can't stop them from randomly grabbing your tax return and go, we're gonna go have a look at this. So I always say, get comfortable with audit risk, but also don't get so comfortable that you think you'll never get audited. We file stuff, we expect to get audited. We don't most of the time, but we're not filing anything saying, oh, good, hopefully this doesn't get audited. With that said, I will say every 3 years, I just wipe paper out. That one's gone. I didn't catch me on that. All legal, okay? We talked to clients' tax brackets. Okay, this is so important and it's so simple. You gotta understand tax brackets, personal tax brackets, corporate tax brackets. Personally, your first 50,000 is taxed at 20%. Your next 50 at 30, your next 50 at 40, everything over that is 50%. Simple. Okay, that's all you gotta know. You really gotta build that in. It's pretty close to the exact numbers. Don't even try to work with the exact numbers. Your first 50 is 20%, your next 50 is 30, your next 50 is 40%, and the next 50 is 50 and above. Simple. Corporate taxes. If we're incorporated, we're going to talk about that. We get to make $500,000 of income taxed at 12%. That's cool. Okay, really cool. Now, there's two types of income we're going to talk about in the court. We'll get there. Active and passive. Active income is just income from what you do. Okay, 12%. Passive income in the world of real estate investors are really net rent income. That's passive income. And mortgage interest is passive income. When you have passive income, you're paying 50%, 50. Okay, we don't like 50. All the more reason why your tax situation needs to strategize with your investment situation. So on move that over a little bit. Yeah, so that's what I focus on, 12%. When I wrap my brain around whatever I'm doing with a client from a tax perspective, we're trying to optimize 12%. Okay, that's a cheap tax rate. We have to pay taxes, but we shouldn't be paying 50 or 50%. When we pay 12% tax, we create 88 cent dollars. Okay, that's magic. Okay, then we would do a lot of focus on these 88 cent dollars. We'll talk a little bit more about that. Where are we at here? Okay, CPP issues. Oh God, CPP. So we're gonna get a tear in my eye here because this is about my friend who died recently, and it just highlighted what a ripoff CPP is. Okay, I really mean that. So my friend dies, 64, from age 18 to age 64. He's an HVAC guy, meaning he gets up at 6 in the morning, works hard all day long. And he did that from 18 all the way to 64. Did not have a surviving spouse, contributed max to CPP from age 18 to age 64, dies and gets nothing. $2,500 death benefit to the estate. Nothing. 18 to 64. You figure out how much CPP contribution money doubles, rule of 72. 10 years, if you make 7.2%, the CPP fund makes a lot of money because they invest a lot in private equity. There's $1 million in this guy's CPP fund, and he gets nothing. That is a ripoff, sorry to say. Such a ripoff. So we strategize around that. Okay, so if you can, we'll talk about that, not right this second, but soon. Okay, so CPP is bad. I don't want my clients paying CPP if they don't have to. Dividends. Okay, when we take money out of a corporation, we get to what's called characterize what that money is. So we're taking money out of a corp. Is it wages? Is it fees? Is it bonus? Is it a dividend? Is it a repayment of shareholder account? The ability to characterize this income allows us to use dividends. Okay. A dividend in simple terms is money paid out of 88-cent dollars. The corporation has already paid 12%. We have 88-cent dollars. That's where we pay the dividends out from, and the tax system gives us a dividend tax credit because the corporation has already paid some tax. Not getting into the nitty gritty of it all, you could take out about, if you had no other income, you could take out about $3,500 as a dividend a month, $42,000 a year, no tax. Okay, zero. The corporation would have paid 12, but we're pulling it out personally. Harry, you got a question? Something?
Does the corporation, does the corporation has to make money in order to withdraw dividends?
Yeah, good question. So Harry's asking me, does the corporation have to make money to pay a dividend? And that's a really good question, because technically the answer is yes, but I can't count so many times I have issued dividends out of negative retained earnings. So the correct answer is yes. Corporation needs to have retained earnings, so make money, pay 12%, that's retained earnings, 88 dollars. But I've issued many dividends with negative retained earnings. So the right answer is yes. The practical answer is maybe.
Gray area.
Gray area, bingo, 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 bingo. You don't play in the gray area, you don't save taxes. So we're gonna talk a little bit more about dividends, but that extra thousand, if you have a corporation, you can take a tax-free car allowance. You can take a tax-free office and home allowance. So I'm gonna talk about that a little more, but I just wanna highlight that we can take out 3,500 a month dividend, tax-free, 42,000, plus 12,000 a month for office and home, plus 1,000 a month for a car. We're pulling out $66,000 out of our corporation, tax-free. Okay, and sometimes if you want to go a little closer to the edge of the cliff, you make those $1,000 $1,500. And now we're taking out 70-some thousand dollars tax-free. Haven't broken any laws. Okay, it's just being a little more creative. And again, so the next thing, characterize. So I already talked about that. We characterize it. Over there on the left, Prex. Oh my God, who's the real estate agents? Hands up. My God, you guys have been given a gift from CRA. The ability to channel income into a corporation. You've never been able to do that. I have done so many real estate agents in my life before Prex, and they do good. We deduct their expenses. I calculate their net income, sales minus expenses equals net income. It goes into your personal tax brackets of your 20, 30, 40, 50. And the amount of money these real estate agents have been paying before Prex was just mind-boggling. And I don't know why, but real estate agents just accepted it. Okay, well, I gotta pay 100,000 in tax, okay. 1,000, Jesus. So anyway, Prex are the best thing that ever happened to you. I can't believe the misinformation that's out there. When we first came out, August 2020, the Prex came out. Oh, you gotta make $400,000 before that works for you. Really? The CPP right now, if you do not have a Prex, as self-employed income, you're paying 7,000 into Canada pension just on 50,000 of net income. Sales minus expenses equals net income. That goes over there to your 20, 30, 40, 50 tax brackets. It also goes into the CPP calculation, and you will pay $7,000 of Canada pension. So when somebody says to me, oh, that realtor, you only make $100,000. I'm like, yeah, okay, but you want to save 7,000 on CPP every year. And when I say save, the other side of that equation is, well, I mean, shouldn't I be putting into Canada pension so I can have some money when I'm 65? Of course, yes, I'm not saying don't put money into a savings plan. Why do you have to put it into Canada pension plan? Why not create your own savings plan? Do you want to create your own Canada pension plan inside your corporation? So for those clients that we do not pay Canada pension, I make sure they say, hey, take that same 7,000 or 6,000 divided by 12, $500, and put 500 a month in a corporate investment account. There's your Canada pension plan. And it's yours. It belongs to you. It goes to your loved ones. Any questions I should ask? Because this is, if you got questions, just jump in. So Where are we at now? Yeah, Prax, we're gonna talk a little bit more about Prax. We also use Prax in the real estate world. And a Prac is just a corporation. So when I say Prac, a personal real estate corporation, it applies to anybody that can incorporate, that can channel their income into a corporation. Yes,
Do the preps have to be owned by an individual?
yes. So the question is, do the Pracs need to be owned by an individual? That's the question. Yeah, so when the Pracs were finally allowed, took a long time. Somebody in your real estate industry deserves a big thank for that. Because they lobbied for years and years and years. So one of the requirements is that the real estate agent must be sole owner of the corp.
What if they own a corp solely and then that corp owns the prec?
No, the prec has to be owned by the person. Okay, as far as the common voting shares, you can have a prec, you can create other types of shares that are non-voting. The voting shares have to be owned 100% by the real estate agent. Okay, so there's all kinds of ways that we can channel income. We have non-voting shares, pref shares, different class of shares, so we can have different entities own it. But we do have to have that requirement. What else? Should we incorporate holding companies? Yes, of course. I'm gonna bring out this little chart right now because this is kind of, I don't think our owl people are gonna be able to see this, but I'm gonna explain this to these people here. Hang on. Okay, so this little chart kind of summarizes what I just talked about. And I'm sorry about Al, I don't know if Al's catching this, but here's kind of what I just talked about. All right. So we have a person owns corp. Okay, if you don't have the corp, there's your tax brackets. First 50 is 20%, next 50 is 30, next 50 is 40, next 50 is next 20,000. Yeah, next 50,000 is 50. So 50,000, next 50, next 50, next 50. If our income flows here. So if we were self-employed, we would have sales minus expenses equal net income. It just flows through here and applies to our tax brackets. If we owned a real estate property personally, okay, we would just have rent minus expenses equals net rent income. It just flows through here. Okay, now when we set up our corporation, we flow our income here. So whatever we do, if we're self-employed, sales minus expenses equals net rent income. It goes in here. Is it active income or passive income? Well, if it's business income, it's active income. We pay 12%. And then we have to get the money over our tax line. Okay, and as I mentioned, we characterize this money that comes from corp to personal. Is it a dividend? Is it a repayment of shareholders account? Is it a fee? Is it a bonus? Is it a salary? There's all kinds of tax stuff that we can figure out to minimize your tax. But this is magic. Okay, again, up here, if you don't have a corp, not only is your net income going here, it's going to go into the CPP calculation. That's $7,000 a year going up. Here, we have the option to say, no, I don't want to pay CPP. I want to put this into my own investment account. Okay, so this is powerful stuff. And basically what happens, the next little slide there was if we had a holding company. So what happens when we earn 88 dollars in here, we really don't want this thing owning a lot of assets. Okay, in our accounting minds, we work with balance sheet and income statement. Balance sheet is assets and liabilities. Income statements is income and expenses. We don't want assets in this corp. We want income in this corp. When this corp has a whole bunch of 88 dollars and we want to buy something, we have to move it up out of this corp. Well, we don't want to cross the tax line, so we put a holding company in here. Okay, we can send those 88 dollars, we can do retained earnings from operating corp into the holding corp. Okay, this is a very important concept to grasp. So important that I'm going to get back to my owl and put this right here for people. So when we talk about, all right, owl people, we're back. Does that make sense to people? Ask your question now. Adele.
When you take the money out of the corp and you're talking about that 70,000, whatever you said,
Yeah.
it's tax free, doesn't go to, so it doesn't count towards when you get CPP, OAS, any other
So the question was, if we take money out of a corp, does it count for anything else? Sorry, what,
Yeah, like the income portion, like, you know, when. they
well,
calculate-
okay, so let me say,
if
when
we're
we
paying
take,
back for
when, clawbacks for old age security, different thing. When we take money out of a corp, or when you take money out of a corp, we as accountants can decide what it is. And that's, again, I repeat myself continuously, the integration of investments and tax is so important. So when you take money out of a company, we get to decide how to deal with it from a tax perspective. And we usually suggest to really, if you can live on $66,000 a year, we can pull all that money out of your corporation tax free. Right? Your corporation can pay a lot of the things that you need to do. We need housing, we need food, most of us need a car. There's three things that basically all of us need. So the more we can pay 88 the more we can use 88 cent dollars to pay those expenses, the more tax you're saving. Okay, if you're gonna take all the money out of the court, pay tax at 50%, and then start paying your car and your house and everything else, that doesn't make a lot of tax sense to me. Harry?
Yeah, you just mentioned that if you do not have any other income, then you can withdraw the dividend income. So what
Yeah,
if you're
no,
making,
then that's true. Like if you have other income, I'm just talking about if you have no other income.
but if you have. other
Yeah, so
income,
now you got other income, which just means we have to strategize this thing more. Okay, so again, all the more reason why wherever you're getting your income, either from investments or another job or a side hustle, we have to integrate all that into what we're doing. All I'm saying is you can make $66,000 tax free. If you're gonna make more money than that personally, yes, we're gonna deal with the tax issue. But that's okay, because we've already pulled out 66 free. I'm not someone who believes in paying no taxes. Okay, we have to pay tax. We need roads, healthcare, we need this stuff. But I'm also somebody who says, every dollar I send this to the government, half of it's wasted.
Yeah,
It's just wasted. So yeah, I'll pay them 50 cents. They're wasting my other half of my money. I'll give you 50 cents. I feel good. I've contributed. Okay, you can't not pay any taxes. Well, you can, but that's another conversation. What else do we got here, Aaron? So again, integrating taxes, is again, think of the income flow. Okay, when we have any income, if we have business income, sales minus expenses equals net income. That net income has to show up on a tax return, either a personal tax return or a corporate tax return. If we have net rent income, okay, that number has to show on a tax return, personal tax return or corporate. If we have investments, we either get interest, dividends, capital gains, and then this ROC, return of capital, that's magic, as we'll find out soon. So when we have investments, if we earn $100, if it's interest, we have to put $100 on the tax return. If it's a dividend, we can put approximately $75 on the tax return. 25 is tax-free. If it's capital gains, half of it is tax-free, half of it has to land on a tax return. If it's return of capital, zero goes on your tax return. We don't pay tax on the income received as return of capital. We'll talk a little bit more about that, but that stuff is magic. You only get return of capital from real estate income trusts, which we'll talk about. Also, there's a lot of confusion on that one point before you leave there. The net rent income. You get all kinds of people that own, most people own rental properties. We're real estate investors. We encourage people to own their own rental properties. There's a lot of confusion around, do I hold the property in my personal name? Do I hold it in the corporate name? Okay, and I get too many people coming to me and going, oh, I own a rental property, and so I guess I have to incorporate, transfer the property into the corporation. No, we're more concerned with the income flow. Remember, again, my brain works balance sheet, income statement, assets and liabilities, income and expenses. So first question is, where do we hold the building? Second question is, where's the income going? There's nothing wrong with holding the building personally. Okay, and again, you gotta also remember who's giving you the advice. If you go to a lawyer, there's two reasons why we incorporate tax and liability. So if you go to a lawyer, they should be saying to you, yes, every building you own should be in a separate corporation because their job is to protect you from liability. When you talk to an accountant, and you know, am I gonna say all your buildings have to be in a corporation? No. Who really care where they're held? I care about the income. Okay, that's what we're trying to solve. So if you already have a building in your name personally, that's okay. But if you're in a 50% bracket, tax bracket, let's say you have a job and you make $150,000, you're in a 50% tax bracket, and you have a rental building and you have net rent income. Well, that's going to go on top of your 50%. Half of that money is going away. That's not good. So what do? Well, we certainly don't transfer the building into the corp. We create a corp to manage your personal building. So we take the net rent income and convert it into management income. Management income in a corp is 12%. Okay, so that's one way we do it. If we already have the building in the corp, net, as I mentioned before, net rent income is passive income. So if you have a building, if it's in the corp, if there's net rent income, we're paying 50% on that. That's not good. So what do we do there? Open a second corp. Okay, and it will be our management company. So we will once again take that net rent income and instead of paying 50%, we'll convert it to management income. Okay, again, for many times you got to strategize with your investments and your tax. Harry.
Is there any stipulation on how much percentage of your rental income goes towards the management?
It has to be reasonable. Thank you, Harry. It has to be reasonable. Okay, what is reasonable? Well, if you want to just call somebody third party to manage your property, you're probably going to pay 8-10%. So if you have 100,000 of gross rent and we're taking 10,000 of that over to the management company, we should be okay in an audit. What if we make 25,000 net rent? I know what I'm doing. I'm moving 25,000 into my management company. Is that illegal? No. Is it unreasonable? Yes. Will it pass an audit? Probably not. That's why every 3 years. Okay, so you get it's not illegal. It might not pass an audit. So it is what it is. So I like saving tax. Next one, Duran. Anyway, real estate. We love real estate. So much so, it's got its own separate slide. Yes, sorry.
Can I run the management company out of my truck?
Yes. Yes. Yeah, you're correct to do that. The only thing, listen up, real estate guys, listen up. The only thing your correct cannot do is present itself as being the entity that is buying and selling a house for somebody. That's the only thing. It's the only thing. It can do everything else. Management company, hold assets, everything else. Just the industry. And the reason they do it is the same reason why everybody else, doctors were early in the game wanted, because they're basically saying, hey, we want to pay 12% tax on their income. And they're, no, you can't hide behind the liability of a corporation. So they eventually allowed them to channel their income into a corp, pay the 12% tax, but not be able to hide behind the liability of a corp. We as accountants fought for it. We can channel our income into a corp, but we cannot hide behind the liability of a corp. The real estate agents finally can channel your income into it, but you cannot hide behind the liability of a corp, which means your corp should not be perceived as the entity buying and selling houses. Okay, you can't say John Smith Incorporated will buy and sell your house for you, real estate license number so and so, so and so. You cannot do that. We're good? Question? Sorry.
What happens if you get caught in audit?
So if you get caught, okay, nobody's going to jail. So they have 3 years. Okay, so it's the system, their computer spits out a notice of assessment. And they have 3 years from that date to question or challenge anything on the tax return. And if they don't like something, they will reverse it. They'll spit out a notice of reassessment. they'll say, you owe us this money. They'll go back to when you should have paid the money and charge interest. That's irrelevant. That's not a big number, so that doesn't scare us off. Yeah, that's the risk, is they'll reassess. You know, hey, Gerry, 25,000 out of 100,000 of rent, no, that's too much. Okay, nobody's going to jail, nobody's getting charged. Okay. Well, because we're not gonna take it that far, you know, we're gonna be reasonable and a little beyond. But we're not gonna get to the point that, okay, we better hope we don't get audited, because sorry, you're gonna end up in jail if you get audited. No, we're not gonna go that far. Correct, that's bingo, I couldn't say it better. So I repeat, take a little bit of audit risk in your life. Quit paying all these taxes, man. You know how the system just take it, take it, take it, take it, take it, take it, take it. I mean, balanced budget, what was the thing Tuesday?
What's that?
$50 billion. Oh, we're gonna try to keep our deficit under $50 billion this year.
Budget's balanced every time.
Hmm?
Budget's balanced every
Did did you vote liberal? Are you one of those guys? Are you one of you believe that?
The balance is itself.
Yeah, I think he regrets saying that. That's funny. Balance, I never said that when they wrote it. What? Like the city of Toronto, 1.5 billion. Municipalities can't pass, you know, they have to balance their budgets. Municipalities have to, province doesn't, feds don't. So I live in Toronto, so we're in a $1.5 billion shortfall. And that's just for this year. There's one thing, if that problem gets solved, they could issue a debenture. Okay, there, we've got our 1.5 billion. Next year is the same problem again. It's just. Anyway, yes, real estate. We love real estate so much. It has its own page here. So, cash flow versus speculation. I think I touched on that. In that, you know, most of the time we're not speculating. We don't like speculating. It's more cash flow. We like good real estate, bad real estate. You get good real estate, you know, buying on a cash flow basis. You know, and we really base a lot of our decisions on what we know. You know, what do we know for sure? Well, we just talked about our national debt. Insanity. Okay, especially since COVID. I mean, I remember it years ago, we used to, oh my God, we're like $100 billion in debt. You know, debt is the accumulated debt. Deficit is annual. You know, then it's 200 billion, and now we're into the trillions and gazillions. I mean, it's just mind-boggling. But we know that. And what does that mean to our real estate decision? Well, we do know that while our debt goes way up, one way they defend that is correlating it to the GDP. Oh, our debt's yes, it's so high, but you know, our GDP, debt to GDP is good, so they gotta keep the GDP up. How do they keep the GDP up? They open the floodgates, let them in, let everybody in. Okay, they've been doing it for 30 years. I'm a Democrat. That's you know, I I came to this country, but they're doing it now, and really what they're doing now is opening the floodgates even more, because that GDP has to go way up. So what does that mean to us as real estate investors? Well, people need a place to live, and those floodgates got opened up quite a bit to deal with this issue, and look where we're at. People sleeping on the streets, big affordable housing crisis. Um, it's not going to get solved. They can't build houses fast enough. And what is affordable housing? Like, okay, this was instead of $1 million, this is $900,000. So I don't know how they solve the problem. All I know as a real estate investor is when we look at business models and when we talk about apartment buildings and buying cash flow, our revenue stream is rental, residential rent. That is strong. Okay, so I have no problem basing investment decisions on the fact that rental income will remain strong. It will. People can't buy houses, even the seniors, people who have houses. I've seen a lot of people cash it out and just renting. A lot of them. So the rental market is strong, really strong. The other thing I like about the rental market is there's no correlation to the stock market, and there's really no housing. The housing market can go way up. The rents are just gonna, you know, the housing market, so the rents will go up. When the housing market comes down, the rents really are not going to come down. Certainly not enough to mess up our business model. You know, if you're getting $2,000 a month for rent, and the market floods, so you might go down to 1,800. That's not going to mess up your business model. So we like everything about, so when we talk about, again, these two boards here, this is all our investment marketplace. This is where we get our IPs. This is where we get our investment products. This is all real estate related investment products. Over here is more the stock market under MFDA and IROC. Then we have this thing called the exempt market. And what the heck is that? What is private equity? Okay. Exempt market means it's exempt of a prospectus. What does that mean? When you have publicly traded companies, one of the processes of taking a private company public is they have to create a prospectus for investors. So anybody interested in investing in a publicly traded company is given a prospectus. And to put it into perspective, think of a 500-page prospectus with really small writing. Nobody reads it, but they go, here's a 500-page document, you're informed. But you can't say you weren't informed about this decision. It's a joke, these prospectuses. Nobody reads them. Okay, so when we deal with private equity, we are exempt of these prospectuses. So instead of a prospectus, a perspectives with the private equity world has to do is create an offering memorandum. And instead of it being a 500-page document with really small writing, an offering memorandum is a 50-page document with big writing. Okay, people read this stuff. Okay, so in the private equity world, we go to the exempt market to get private equity, and my very favorite product of all lies in this private equity world, and that is real estate income trusts. Okay, real estate income trusts are a fund of apartment buildings. We all understand how it works. They collect rent, they pay the insurance, the property taxes. There's money left over. It's distributed to the investors. That distribution is return of capital. You do not pay tax on that distribution. Okay, it does catch up with you because everything you receive tax-free reduces your adjusted cost base. So when you eventually sell, you're converting that money you received into a capital gain. Probably making it sound more complicated than it is. Trust me, a return on capital is a really good thing. And you only get them in real estate income trusts, which sets up the introduction to my good friend David Grossman. So, as mentioned, the way I run Canadian Investment Services, there's a whole bunch of investment products here, which are real estate related. There's a whole bunch of investment products here that are not real estate related, except in the exempt market. And that's where we find private equity and real estate income trust. So the way I have my company set up, I can talk all about this stuff. I cannot process an order. I do not have a license. So I thought I would invite my good friend David, who is a dealing rep through the exempt market. He has a private equity license. So he's going to talk to us, if you don't mind, a little bit about private equity, real estate income trust. I know there's even different types of private equity. I like to focus on the real estate, but I know there's other opportunities in the private equity world. So, David, come say hi.
Thank you very much. Hi, everybody. I'm David Grossman, as Gerry said, and we've been working together for a while. I'm also a mortgage broker. I've been a mortgage broker for 20 years, and over the years, many people said to me that they want to invest in mortgages. And I never had enough private mortgage deals. So one day I thought, okay, I like some of these products in the exempt space. So I went ahead and I got my dealing representative license. And so Gerry and I have been working together now for a number of years doing events. We were doing them weekly in Toronto before COVID hit. And now we do them, some in person and some online. And like Gerry explained, this OWL. So this allows us to have some people online. There were over 50 people who registered online, and 20 of them are on. But we'll send out the presentation to them. But nothing like seeing people in person. So it's very nice that that you all came out. It's nice to see you all. So as Gerry said, what is the exempt market space? It means you're exempt from doing a prospectus. So it's a very long document that nobody reads. I'm not convinced that anybody actually reads an offering memorandum either, because that's a kind of a long and boring document too. But anybody who wants to read it sure is welcome to do so. And REITs, the real estate income trusts, are a very popular product. It's not the only product that we offer, and there are different types of REITs too. I know that Gerry likes the apartment REITs. They're cash flowing properties, and a typical model for the companies that we offer people opportunities to invest in is one where the management will look for apartment buildings that are generating below market rents, where there's an upside potential. There's a lot of buildings out there that are owned by the same owners who have owned them for decades, and they're not really doing much to optimize rents, to minimize costs, to be very efficient. And these companies go in and they will gradually turn over the tenants and often dramatically improve the rents. And if you're in the real estate, if you're a real estate agent, or even if you're just a real estate investor, you'll know that residential real estate, small or single family, is different from multifamily. When you have 5 units and up, the valuation of the building is largely based on, or almost entirely based on, the net operating income. So it's all about the income. Whereas a smaller property, 1 or 2 units, it's more of an emotional purchase, similar to stocks, right? People are buying and selling, and the value isn't necessarily representative of the actual value. So if you can take an apartment, single, unit in a building, and increase the rent from $1,200 a month to $2,000 a month by doing some modest renovation, you can dramatically improve the value of the building. And that's what a lot of these companies are doing. Many of the properties, the apartment buildings that are owned, they're in Ontario. They're 1 or 2 hours from Toronto area. Some of them have apartment buildings across Canada, and in some places in the US. And many of them have a track record of earning 10, 12, 14% returns for 10 plus years. So we tend to stick with the REITs that have a very good track record. They're RRSP eligible, TFSA eligible, and we can never recommend that somebody takes all of their investable assets and put it into REITs, although some people are tempted, because there is a lot of still, even though it's prospectus isn't required, it is a very heavily regulated industry. I can tell you that there's more compliance required in the private market space than there is in the mortgage space. I can tell you that for certain, especially with the company that I work with, Pinnacle Wealth Brokers. They look very closely at what we're recommending, to products that we're recommending, make sure it's suitable. And even people who really love the real estate, we do recommend some amount of diversification. And one example of a fund that I like is a dental fund. It's a company that is buying dental practices across Canada. In the US, approximately 30% of dental practices are corporately owned. In Canada, it's only about 10%. So this company, in particular, New Look Dental is what they're called, if you want to look them up. They own about 50 dental practices in a few different provinces in Canada. And dental care is the most profitable sector in healthcare altogether. And going to the dentist, maybe some elective cosmetic procedures people will pass in harder times, but basic care, I mean, dental's gonna be up there. When you need to see your dentist, you're gonna go see your dentist. A lot of people have dental insurance. So their dental, their costs are covered. So that's just one example, of something that we say is kind of recession resilient. Another one, it's owned by the same company, New Look. It's called New Look Industrial. And they own companies that do have contracts with governments and regulated services, like, for example, smoke detection, alarms, elevator maintenance, telecommunication tower maintenance, that type of thing. So that's just a question.
Yes, this is with regards to New Look Dental.
Yes.
So when you say they own dental offices, what do you mean? Please elaborate.
Yeah, so they go out and they buy dental practices. So they're looking for offices that are generating more than $1 million in revenue. And these are dentists. Sometimes they're ready to retire, they're close to retiring, and they're the company, a New Look will go in and they will help that particular without changing the culture of that particular office, because every office has a bit of a different culture. They will find ways to maximize. For example, Invisalign is a new technology that many people use. So they'll make sure that they're up to speed with all of the latest technologies and revenue opportunities, cost savings, and they buy dental practices, and they've been gradually buying more and more dental practices. So New Look Dental offers a modest 9% debenture. So it doesn't have the opportunity for growth